So the next environmental hazard we take a look at is this toxic mold. I think that's pretty cut and dry. I'm sure everybody knows what mold is. And, obviously we're talking about toxic mold because there are different types of mold for sure. Some of it, I guess, not as toxic as others. But, one thing you want to be careful with, especially when it comes to the mold, you can see little dark patches or spots on walls or whatnot, and it's sometimes we're quick to just jump to the assumption of, well, that's mold. One thing I don't think would be a good idea as real estate agents is to start claiming what's mold and what's not, because again, some of it is toxic, which is not good, and we're referring to that right here. But there's also some that's maybe not so toxic, and you just don't want to speak out of line. Don't try to make yourself the mold expert. But if you see something that looks like mold, you might want to suggest, or at least say, look, there is some growth here in the bathroom or in the kitchen or wherever you see it. But obviously I'm not an expert to be able to say exactly what it is or that it's toxic or not. But now, having said all that, if you do have someone that is skilled, knowledgeable about this situation, and they've told you there's mold, then obviously that has to be disclosed, right? All right. And then the next one you see here is lead-based paint. Now, this is a biggie, and I can guarantee you they will ask you at least one or at least maybe a couple questions about lead-based paint. As I said earlier, it just seems like where you see most of the issues, at least in terms of hazardous issues with houses, are those that were built like in the 70s or before. And, this is just one more hazard that, it used to be used a lot. It's very common to use lead-based paint. And we like to use it because, it's just a very durable paint. Very durable. Didn't have to, once you painted something with lead paint, then it was painted. You didn't have to worry about painting this again for a while. But unfortunately, we've now learned that the lead can cause, again, some pretty serious health issues. Obviously, if it's ingested, and that's where the issue comes in, if it's ingested. So, anyway, so in 1977 is actually when lead-based paint was outlawed. That's when we determined that lead paint is bad for us. We're not using it. Lead-based paint is now a no-no. So what we're required to know and disclose here, and this would pertain to any residential property built prior to 1978. That's the date you need to remember. 1978. I promise you'll see that a question where you better know that year. Any house built prior to 1978, there is the potential that there's lead paint in that house. Now, it may have been painted over with some other paint at this point, but that doesn't take away from the fact that there could still be lead paint somewhere underneath and on that wall or in the house. So here's what you're required to do. You must disclose to all and this is a written disclosure. There's a form that has to be filled out and signed by both the seller and the buyer. Now the seller has to make some disclosures here, okay? And basically they have to choose between one of two disclosures. The seller could just say, I have no knowledge as to whether there's lead paint in the house or not. And I will tell you that's typically what most sellers will claim. And hopefully, truthfully, and rightfully so. Most of us know that, yes, it could be here, but I don't have any factual knowledge that it's either here or not here. So they will put on their form, basically kind of check the box saying, I have no knowledge of lead paint. Now there's another option there that says that I do have knowledge and that there is or is not lead paint in the house. Okay. And then the buyer would have to basically sign off, acknowledging that they've been made aware of what the seller knows or doesn't know. And then the buyer actually, again, on this form, will have the right to have a lead-based paint inspection performed, obviously during their due diligence period, if they choose to. And if you want to have that lead paint inspection done, then you must indicate it on that form. Okay. But I will tell you, I'm sure there are some that have done it, but everyone, I don't recall ever having a buyer choose to want to do that. They usually choose that they waive their right to a lead paint inspection. But then you see there's also this pamphlet, you see a little picture of it there on the slide. It's several pages, quite frankly, but it's just a pamphlet providing information about the potential problems with lead-based paint. So what is it that we're required to disclose? One, you got to disclose that because this house was built prior to 1978, we must fill out and sign a lead-based paint disclosure form. And, if you're that buyer's agent, you must provide a copy of this EPA pamphlet. It's just called Protect Your Family from Lead in Your Home. You got to provide a copy of that pamphlet to the buyer. And then the buyer must acknowledge on that disclosure form they have to sign, they must acknowledge that you gave them a copy of this pamphlet. Okay? So those are the requirements when it comes to lead-based paint. Wetlands. Obviously wetlands are, now we're talking about primarily areas that have been designated as a wetlands, a protected area. And obviously, could you own or could someone own property that actually has a wetlands, a protected area, actually own the property? Can you own a protected wetlands area? Yes, you can. And obviously, if any portion of the property you're trying to sell or convey is in a wetlands area, then you must disclose that, because there are some pretty severe penalties. You get into some of these protected areas and think you're going to try to clean it out, cut out some of the brush, backfill it with some topsoil, trying to fill it in. I'm telling you, there are some serious penalties for that. So you got to know if it is a protected wetlands area, okay? I will tell you there are, I don't know the URL right off the top of my head, but there's FEMA websites that you can actually go to, put in a property address, and it will actually pull up that property and indicate whether there's any wetlands associated with that particular parcel of land. Obviously, if you're selling a piece of property and it does seem to be very low, almost swampy, marshy type areas, then you might want to look into that. I'm just telling you, that could be a protected area, or at least some part of it may be. And you better make that disclosure if it is. Absolutely better. And then the last of these environmental issues is something called brownfield sites. These are contaminated, hazardous sites. You could potentially get a question, and I would just be familiar with the term Brownsfield. That's a critical term in the area of environmental hazards. These hazardous sites. But let's just look what it says. While the presence of contamination can complicate the process, successful redevelopment of brownfield sites can lead to significant economic, environmental, and community benefits. What they're talking about, we need to clean these hazardous sites up. If we can get them cleaned up, we can make this more usable property again. It creates more economic wealth in cases like that. But with this, it says, with the support of government programs and incentives, brownfield sites can be transformed from liabilities into something that is more valuable. Okay. But what is brownfield sites? It's a contaminated area. And there are programs, government programs out there that you can actually get assistance from, financial assistance, to try to clean it up, make the property area beneficial, something that we can use again. Okay. Well, there is this act here, and I kind of touched on it, but just to go over it. It says the BUILD Act reauthorized the Environmental Protection Agency Brownfield Program and made significant amendments to the 2002 Small Business Liability Relief and Brownfield. Again, all it's saying is, that there are, by law now, there is some government assistance available to clean up some of these environmental wastelands, environmental hazardous sites. Okay. And here they talk about some of these, the grants. We just talked about that, money being available, the ownership and liability provisions. It says adjustments that may impact property owners and developers' liability protections, encouraging more parties to engage in the redevelopment. In other words, we're just trying to incentivize the cleanup of some of these hazardous sites. Okay. That's all they're trying to do there. All right, so now let's look at some real estate or real property tax laws. There's a few here that you need to be aware of. Some of them, I think most people would think would be a positive tax law. Some of them maybe not so. But let's just take a look at them. But we're going to first start with some tax breaks that you may be eligible for if you own real estate. And I will tell you, some of the stuff we get ready to talk about right now is the reason most people would prefer to own real estate versus renting, leasing real estate. But one of these tax breaks would be mortgage interest deductions. Obviously, if you're borrowing money to buy real estate, you got to pay the money back with interest. Well, the good news is most, if not all, of the interest you're paying is tax deductible. And what it's saying here is, you can actually deduct up to $1.1 million in mortgage interest for tax purposes. Now, how'd they come up with the 1.1 million? Well, they're saying that the interest you paid on acquisition debt. Now, first of all, what is acquisition debt? That's the money you initially borrowed to purchase the property. That's what you borrowed to make the acquisition. It says you can deduct interest on debt up to $1 million on the acquisition debt. But then it says that, if you take out a HELOC, your home equity line of credit at some point in the future, you can also deduct the interest on those payments for up to $100,000. Okay, so between the acquisition debt and the home equity debt, potentially you could deduct up to $1.1 million. That's a huge write-off right there for tax purposes. Okay. Same thing when it comes to property tax deductions. Look, nobody likes paying property taxes, I'm sure. But at least on the bright side, I can write that off for tax purposes. It's another tax deduction at the end of the year. So that's a good thing. And then there's this thing called the homestead exemption. Now, I'm going to tell you, my guess is probably every state has some form of homestead exemption. They do not all work the same. They do not all have the same benefits, from each state. So again, this is another area where when we get into the state-specific portion, we'll have to look at what is the exact benefits of the homestead exemption for your state. But right now, we're just kind of looking at a very broad overview of what it is. But yeah, it's basically just a discount on real property taxes, okay? And it says most states will offer an exemption to, and they list some things, who could qualify potentially for the homestead exemption. But, and again, these are just examples. There may be more that other states recognize. Some states may not recognize all of these. But anyway, people with disabilities, older adults, senior citizens, veterans, law enforcement, first responders, may very well qualify for the homestead exemption. Again, it's just a discount in what you would actually have to pay on your property taxes. Get more specific in the state portion of it. But then there's the discount points, another tax break. And we'll actually be talking about discount points here in a couple more chapters from now, in the finance chapter. But what are discount points? When you buy a discount point, that lowers your interest rate. So you can actually buy down your interest rate. So obviously if you're borrowing money to buy real estate and you don't like what the interest rate is, potentially you could buy discount points that would lower your rate. So you can actually buy down your interest rate. But all these discount points are, it's just prepaid interest that you're paying up front. It's just prepaid interest. And because you're paying this interest up front, then that lowers the rate that you would normally pay over the course of the loan. Now here's the kind of the good part about these discount points. First of all, how much does a discount point cost? 1 point. And you'll see this again later, but 1 point costs 1% of the purchase price. Now, I'm going to tell you this. There's some memory items right here on the slide, okay, for test purposes. How much does a 1 point cost? 1% of the purchase price. That's not true. Okay. I apologize. There's an error on this slide. It is not 1% of the purchase price. It's 1% of the loan amount. My apologies. It should be correct in your book, but I will get this slide fixed. But anyway, please make that note in your book or highlight it in your book. It's 1% of the loan amount. There's a difference potentially between the loan amount and the purchase price. The interest is not based on the purchase price. It's based on how much you're borrowing, okay, the loan amount. So, if I want to buy 4 points, then that's going to cost me 4% of whatever the loan amount is. Now, how much will each point lower that interest rate? And you see there, it'll lower the interest rate by 1/8 of 1%. Each point will lower it by 1/8. So if you wanted to buy points to lower your interest rate by 1/4 of a point, then obviously that would be 2 points. If you wanted to lower 0.5%, then obviously that's going to be 4 points. And then the cost of it would be 1% of the loan amount for each point that you're buying. Now, here's the other part that's kind of important to remember. Only the buyer, and I stress again, only the buyer can deduct discount points. Only the buyer. And it doesn't matter who pays for them. And the reason we're bringing that up, it is very common in a lot of states, I'm sure, but it is very common that a lot of times buyers, when they make their offer to the seller, they'll actually put in the contract asking the seller to pay at least some portion, if not all, of the buyer's closing cost. And a lot of times sellers will agree to that. Well, part of those closing costs for the buyer may very well include discount points. And y'all, even though technically the seller may be paying for these points, only the buyer can deduct it for tax purposes. You're saying, well, wait a minute. You mean if the buyer doesn't pay for it, they can still deduct it as if they did? Exactly. They can. The buyer can deduct discount points, but the seller cannot. And again, it does not matter who paid for the discount points. All right. Now we get into some of these laws that some people may not like so much. But, the first one we look at is this capital gains tax. And really all this is, if you buy real estate and then at some point in the future decide to sell that real estate and you make money on the sale. You buy it for $200,000, you sell it for $300,000. Did you just make money on that property? Yes. That's considered a capital gain. Capital gains are on, when you're buying or investing in real estate. Well, if you make money on that transaction, guess who's going to want a little bit of it? Uncle Sam. There you go. And they call it a capital gains tax. The money you made is considered a gain, a capital gain. So you will have to pay taxes on that gain. Now, how does this work? Now, first of all, let me just say, we're going to just show you the basics of how they determine the capital gains. Please understand there's a lot more that goes into it than what we're going to be discussing here. So obviously, number one, you should not be acting as your buyer's accountant and giving them, or seller for that matter. You need to always suggest you need to talk to your accountant and let them help you determine when you sell this property how much your capital gains taxes will be, if you will even owe any capital gains. And good chance you won't owe any. But again, we got to stay in our lane. Don't try to become their accountant and give them accounting advice. All right, so let's just look at some of the basics of how this works. First thing we got to know is what is the basis of the property. The basis will always be whatever you paid for the property. So if you paid $100,000 for the property, then your basis is $100,000. That's kind of the baseline. That's the starting point. We got to know what you paid. But then we also, from there, we have to determine what the adjusted basis would be. For example, there are a couple of things you could potentially do over the course of time that you own the property to actually increase the basis. Make it go up. And I will tell you, anytime you can cause your basis to go up, now again, it must be legal, but that's a good thing for you. The higher your basis, the better you're going to be. Now, how do you do that? Number one, any closing cost that you incurred as the buyer, any closing cost you incurred when you bought the property, you can add that to your basis. That's the first thing you can do. The only other thing you could do to increase your basis is, again, during the time you own the property, any capital improvements you make to the property. New roof, or you added on a room, or whatever. Now, we'll tell you, there is a difference between an improvement and a capital improvement. We're not going to go there. Again, that's not our field of expertise. That's for the accountant to decide what type of improvement would qualify as a capital improvement and which ones would not. Let the accountant deal with all that. But assuming it is a capital improvement, whatever the cost of that improvement was, you can add that to your basis. Now, I'll also tell you, you have to report that when you file your income taxes every year. Okay? So if you're making improvements to your home, capital improvements, you better you better indicate that in your tax return, because when you do that, then the IRS will bump up your basis, based on whatever the cost of it was. Otherwise, you don't get that adjusted basis. But then we have to know the amount realized. The amount realized is whatever you sold the property for minus any expenses you incurred in selling it. Closing costs. Even realtor commissions would be included in that. So all the costs associated with selling the property, you can deduct that amount from the actual sales price. That indicates the amount you actually realized, okay? And then once you know the amount realized, then you take your adjusted basis, whatever that was, subtract it from the amount realized, and that will represent your gain or capital gain, if there was any. And then whatever they determine is a capital gain, then obviously you're going to owe taxes on whatever that amount was. All right, so let's look at an example of what I just talked about. We had a purchase price in this example of $100,000. So that's our basis. We had capital improvements, over the course of the time we owned it. In this example, $25,000. So, and y'all know why my slides are a little out of my bullet points anyway. But anyhow, you had closing cost of $3,000, capital improvements of $25,000, plus the $100,000 purchase price. So our adjusted basis now is $128,000. Right? It's pretty simple. It's not, at least as far as we're going, it's pretty simple. But just remember that $128,000 is the adjusted basis. But then we go to sell the property and we sold it for $275,000. But remember, we get to deduct any expenses, closing costs, commissions, any expense the seller incurred. And in this example, we're going to say the seller had $15,000 in expenses. So the amount realized is actually $260,000. Okay, well now you should be able to figure out what was your gain. So if I take the amount realized, $260,000, minus the $128,000 adjusted basis, that's going to leave me with a capital gain of $132,000. That's what I made on the property. Guess who's going to want a little bit of it? Yep, got to pay taxes on that $132,000. Okay. Now here's the good news about capital gains taxes. There are exemptions. And these are very substantial exemptions for those that qualify. And we'll talk about who qualifies here in just a second. But for those that qualify for the exemption, here's what you get. If you are a single homeowner, you own the property yourself, there are no other owners, then you're exempt for up to $250,000 in capital gains. So as long as you did not make more than $250,000, then you would be exempt. Okay? Now it says if you're married and you file separate returns. Some couples do different things here. But if you're married and assuming both husband and wife both own the house together, but they file separate tax returns, then each spouse will get a $250,000 exemption, each one. But if you're married and you file a joint return, which is probably what most married couples do, and assuming you're both on title of the property, now you qualify for a $500,000 tax exemption. That's a lot, isn't it? So as long as you didn't make more than $500,000 on this sale, again, that's not the sales price, that's the gain. As long as you didn't make more than $500,000, then potentially you owe no taxes on your capital gains. That's huge right there. But you need to remember those numbers. $250,000 per owner, or just $250,000 if you're a single owner. But if you're married and you file a joint return, then you get a $500,000 exemption. Now, who's exempt? Let's look at that. First of all, you must have owned the property for at least 2 years. So from the time you buy it, you must own it for at least 2 years. If you sell it before you've had it for 2 years, you don't get the exemption. You have to pay taxes on the property. But then it says you must have also lived in the property for at least 2 years out of the last 5 years. So not only do you have to own it, you have to live there. It has to be your primary residence for at least 2 out of the last 5 years. So if it's a rental property and you've never lived there, you don't get this exemption. So you must own the property for 2 years and live in that property for at least 2 years, or at least 2 out of the last 5 years. And then it does say here, now if you do sell the property and you lose money, and that happens occasionally sometimes as well, that is not a write-off. You can't deduct the loss for tax purposes. Okay? All right, so that's your capital gains. But then we take a look at this 1031 tax deferred exchange. Obviously we were just talking about the capital gains tax and the exemption you get if you own and live in that property, obviously for at least 2 years. But what about investors that obviously have no intentions or ever will live in the property? It's a rental property, for example. What about us? Do we get some kind of a tax exemption as well? Well, there's actually, Congress has passed 2 laws, tax laws, to try to help out investors. So this law and the next one we're going to be talking about are just for investors. This is not like owner-occupied properties. But the first one we look at is this 1031 tax deferred exchange. And again, this stuff gets much deeper than what we're going to talk about. We just want enough information to be aware of what it is and have some idea of what's going on here. Again, we're not accountants. Don't try to give advice on any of this stuff. But it is stuff you need to know potentially for test purposes. All right. So if we do a 1031, basically, I think it'd be easier to explain if I just give you an example. Let's say I own 5 rental properties. And to make math easy, we're going to assume that each of the 5 properties are worth $100,000 a piece. So all combined, obviously it's worth $500,000. Okay? Well, what I would like to do is find somebody that owns a house on the beach, somewhere on the beach, and I just want to exchange properties. We just want to exchange properties. Beach owner, I'll give you all 5 of my rental properties for your one house at the beach. That's what I'm trying to attempt here. That's what I'm trying to do. Well, let's say I find somebody willing to do that. But the guy at the beach, or the property at the beach, that property's worth, say, $560,000. Well, would that be a fair, even exchange? No. The guy at the beach, he's going to say, hey, look, I don't mind doing this exchange, but your properties are only worth $500,000. Mine's worth $560,000. We're going to have to even up this trade. So obviously there's a difference of $60,000 in value. So we got to make up that difference somehow. Now, how you make it up is really up to the two parties. Typically, I would have to throw in another $60,000, y'all, in cash or whatever. Now, y'all, I will tell you, it doesn't have to be cash. It could be anything worth $60,000. Y'all, if I got a motorhome, it's worth $60,000, and I'll say I'll throw that in as part of the trade. Y'all, assuming the guy at the beach is willing to do that, then we go ahead and make the exchange. Now, y'all, the $60,000 in this example, or any amount that you use to even up the trade, y'all, that's what we call boot. And I will tell you, you really don't want to be the party receiving the boot, because whoever's receiving the boot will have to pay taxes on the boot. What in this example, $60,000. Not the full value of the exchange, just the value of whatever the boot was. Okay? But y'all, here's why this is a big deal. So if I'm the guy that had the 5 rental properties, did any month, y'all, if we make this exchange, I gave you my 5 properties in exchange for your 1 property at the beach. Was there any money that went into my pockets or even went into my hands? No. Y'all, we just exchanged properties. That's all we did. Well, what about, and by the way, because there was no money that actually came into my hands or in my possession, then how much do I owe in taxes? At least at that time? None. Y'all, so basically that's why they call it a deferred exchange, because you're deferring your taxes. You do not owe taxes at that time. No money came into my possession. But how much money actually came into the possession of the guy at the beach? Y'all, whatever the boot was, in this case, $60,000. So that person will have to pay taxes on the $60,000. Not again, not the full value of the exchange, just whatever the boot was. So, y'all, that's one way for maybe investors to try to avoid capital gains taxes. Instead of selling the property, they just decide we just exchange properties. All right. But another way you could do something very similar is just called a delayed exchange. Y'all, and again, this is for investors, and again, trying to defer or put off having to pay any capital gains tax. But basically, y'all, the gist of a delayed exchange is this. Let's say I've got a rental property. Y'all, so a residential rental property. Here's what I'm wanting to do. I want to sell the property. I'm actually going to sell it. I'm not exchanging it. But I'm going to sell that property, and then I'm going to take all the money that comes out of the sale of that property and put it towards the purchase of another property. Y'all, that's in effect, y'all, in a nutshell, that's what we're doing here. Okay? It's just this time it actually involves the actual sale of a property. Now, but here's what we got to understand. Y'all, whatever you sell that property for, every penny that you get from that sale has to go to another, and in fact the law actually says a like property that you intend to purchase in its place. Couple things that are important about that. Y'all, and by the way, and what I'm about to tell you would also apply to that 1031 exchange. I forgot to say this, but it applies to both the 1031 and this delayed exchange. Y'all, this is not something you can do on your own and be able to apply these laws. You must, this is not an option, you must hire what we refer to as an intermediary. Y'all, someone must handle this transaction on your behalf. You cannot do it yourself. If you try to do it yourself and there's no intermediary, y'all, you do not qualify for this exemption. Neither one of them, 1031 or this delayed. Y'all, because, y'all, for example, here, y'all, when you sell that property, y'all, who's the attorney going to give the sales proceeds to? Y'all, they can't give it to me, y'all, if I'm the owner, because, y'all, if I ever touch that money, y'all, if you ever touch it, even 1 penny of it, the deal is off. You now have to pay taxes on that value, on the full value of the exchange. So, y'all, this is just one of the reasons why you have to have an intermediary, somebody, y'all, it's usually an attorney, but it's someone that's going to handle the transaction on your behalf, okay? So when the attorney goes to write the check for the sales proceeds, y'all, they'll make it out to your intermediary, which obviously will be held in a trust account held by the intermediary, so you don't touch it. Y'all, you're out of the way. This just went straight from the attorney to the intermediary. You're off to the side. You had nothing to do with it. Now, and then it also said the property you're going to buy in its place must be a like property. Again, I don't want to get into the weeds on this, but, y'all, just for example, y'all, if I'm selling a residential rental property, could I use that money to buy a commercial property? Well, if it's a like property, you can. Y'all, and I'm just, y'all, where a lot of people get hung up here and say, well, no. If you're selling a residential property, then a commercial property is not a like property. Y'all, that's not the way this statute looks at what a like property is. Y'all, like is defined by how it's used. So even though, yeah, I've got a residential property, but I'm using it as an income producing property. So as long as the property I'm buying is also an income producing property, then that's considered a like property. So it doesn't necessarily have to be residential for residential. It's how it's used, okay? All right, but enough of that. Now, from the time you actually sell the property, the law says you now have up to 45 days to identify a like property that you're going to purchase in its place. So you got 45 days to identify and choose which property you're going to buy. Y'all, and again, these days here, this time that we're going over right now, these are not suggestions. Y'all, if you do not declare a property to buy within the 45 days, this whole deal is off. So you probably need to have a pretty good idea what you're going to do with the money before you actually sell the property you have, be my suggestion. But anyway, but for test purposes, you need to remember, you have 45 days from the time of the sale to identify another property you're buying. And then from that point, y'all, and by the way, y'all, there's actually a form your intermediary will keep control of. But every time you identify a potential property, doesn't mean you're going to actually buy any particular property. But, y'all, each time you find one that you may potentially buy, you got to notify the intermediary, and they will log that in onto this document. And then by the end of the 45 days, you're going to have to choose one of these properties that you've got on this form here. All right. But then from that point, the law says you now have up to 180 days until you must close on the new property. 180 days before you must close on the property. Now, again, for test purposes, here's where you need to be careful. You do not get 45 days to locate the property and then plus another 180 days to close. Y'all, that 45 days is part of the 180 days you get, which would be the total. So in total, you only have 180 days before you must close on the new property. It's just you've got the first 45 to identify what property you're going to buy. Okay? So, yeah, it seemed like to me, yeah, leave it up to our elected officials. But, y'all, why is it that they write all these laws requiring us to pay taxes on stuff and then have to write 3 or 4 more laws to try to make sure nobody ever has to pay the taxes? Y'all, that makes no sense. It seemed like it would be a lot easier in life and for tax purposes, quit writing laws requiring us to pay taxes, and then you don't have to write all these other laws to try to exempt us from paying it. Hello? Anyway, that would be my suggestion. But again, y'all, don't try to be somebody's accountant. And again, y'all, all you know now about these tax laws is just enough to get through the state exam. Y'all, I promise you there's a lot more that goes into this stuff than what we just talked about. I'm not even going to try to get into the weeds, not that I even know what all of it is and don't want to know. Y'all, accounting just gives me a headache. But anyway, always recommend they talk to an accountant, and you should be good to go.